So chapter 7 is an interesting chapter because it normally would be devoted to cash and cash related issues. But actually the most important part of the chapter is understanding fraud um, and understanding what companies have to do to stop fraud, which is what internal control is. So this is really going to be much of what we discuss today, even though it is in the chapter for cash. So learning objectives 1 and 2 talk about the same thing in terms of internal control. But this is really going to be the only part of the chapter we're going to be focusing on. Okay, so this is what we're going to do. First things first, the book has a limited definition here of fraud. Fraud is actually quite broad a definition, but here we're looking at it specifically between the relationship between an employee and an employer. And in this relationship, it's the employee who is doing a dishonest act against the employer for personal gain. So the employee gets the gain, but the employer gets the cost of that gain. So that's how we're going to be looking at things. Fraud happens, we're human. We live in a very imperfect world, as you probably know. And this is part of our dealings in business, as well as other parts of life. Normally, when fraudulent activity occurs, there are 3 basic factors that come together to create it. The first is the top of the pyramid here, opportunity. And the opportunity is really widespread. Think about when you work for a company, you're given the opportunity to physically handle a lot of the company's assets. The most vulnerable of those assets is cash. So if you're work as a cashier, as a teller, even if you're just waiting tables or whatnot, chances are pretty high you're going to be handling cash. That's part of the opportunity we're talking about here. But employees also handle business supplies. They handle inventory. They have access and sometimes handle various pieces of property, plant, and equipment that the company might have. So when we talk about opportunity, this is the opportunity to access and have access to assets of the company. Okay. Again, the most vulnerable of these is cash. The second part is this issue of financial pressure, which makes perfect sense. Everybody has financial pressures. This is just something that is just part of our life. Everyone has financial pressures, from time to time, some all the time. Financial pressures really stem from the fact that it costs a lot of money to live in our society. The cost of living is high. We pay a lot for our housing. We pay a lot for energy to sort of heat our house and provide hot water. We pay a lot for transportation. We pay a lot for food, healthcare. Cost a lot. And then in general, education, entertainment, other things that we're into to make life worthwhile, all creates financial pressure to some degree. And a lot of people are living, sadly, paycheck to paycheck. And so that financial pressure is real for a lot of people. Now, throw on top of all of that the lovely little addictions that we all somewhat develop over time. And they could be as simple as drinking too much or smoking too much, whether that's cigarettes, marijuana, other things. It costs money. It can be addictive. Gambling, spending money on, or just go, a lot of folks are addicted to shopping. They like to go shop. As soon as they get money, they go spend it. In some cases, these are, some serious issues, behavioral issues. That adds to financial pressures that we have. So in addition to general expenses for life, we have all these little other things that are going on. Now, when you have the opportunity to handle cash and other assets of a company, and you're feeling financial pressures of various sorts, that doesn't mean you're going to commit a fraud by taking it, but it could. It could. Well, what's missing? Well, that third piece here. The third piece of the puzzle here is something called rationalization. And in brief, rationalization is simply convincing yourself that it's okay to do something that you know is not okay to do. So, for example, you've been taught since you were a very young child, certainly at home, and certainly by the time you got to kindergarten or first grade, do not take stuff that doesn't belong to you. You've all heard that since you were really, really small. We know that as adults. Yeah, rationalization tells us that it's okay to take stuff that doesn't belong to us. And it could be something like this. You work for a multi-billion-dollar company. You look at the company as being very rich, very powerful. And you say, well, they're a multi-billion-dollar company. They're not going to miss this inventory. I can take it for me. I deserve it. That's rationalization. Right? You're convincing yourself to take something that belongs to somebody else as being okay, when you know it's not okay. It doesn't matter if the company is a multi-billion-dollar company or not. It's still the act of taking things that are not belonging to you. Rationalization also happens when you get mad at your company. I deserve that promotion. I deserve that raise. They gave it to employee X. Employee X doesn't know what the heck they're doing. I should have gotten that. And, you're handling cash. You're handling other things. They'll never miss it. Right? It's a multi-million-dollar company, this is going to be for me. This is my raise that they never gave me. I'm going to give it to myself. Right? Well, that's rationalization. That's rationalization. You're taking things that don't belong to you. So when all three of these things come together, that's basically what a fraud is, what's a fraudulent activity. And this is true for lots of different assets. But for the most part, cash is the most vulnerable of the assets because it's hard to know who owns it, right? In our society, when you have a dollar bill in your hand, we assume it's your dollar bill. Well, that's part of the problem with cash and why it's so vulnerable. Right? When you're hired by a company, you're going to handle cash that is and belongs to the company. But again, there's a very slippery slope there. It's a fine line. It's easier to know that a company owns supplies or inventory or an asset. There's lots of documentation to show they bought it and they own it and it was received at the door and all this other stuff. It's another thing to manage the cash. It's just a little bit more of a, it's hard to safeguard. It's a much more vulnerable asset. So it's the most common, that's part of the problem of fraud. Okay. Although again, it's not solely. Employees take inventory, employees take supplies, employees take a lot of things from their employers, but cash is the most vulnerable. So what do? Well, Congress had to step in because there were lots of other types of fraudulent activities that were happening in the country, mostly specific to financial statement fraud, where companies would deliberately tell their owners and tell the public, because these are publicly traded corporations, that they earned more money than they did, or they had less debt than they did. That unfortunately resulted in companies like WorldCom and Enron going out of business totally because they basically were fraudulent in their reporting of their financial statements. Thus, the whole system crashed. Congress doesn't really like to get involved with these types of things, but they did with the Sarbanes-Oxley Act way back in, we're talking 2002, 2003, around there. And what that law did is require a bunch of things. First, companies have to put in what we call a system of internal controls, which means they have to put in place procedures to stop fraud from happening, okay, at their business. We're going to look at that in more detail in a moment. Another thing the law did is, for the very first time, very high up executives, president, CEO, vice president, finance, etc., and the board of directors of corporations could go to jail for the first time for perpetuating a fraud on investors. Okay. So they have to do a few things. They have to make sure that the company is putting in these controls, and they have to also attest through their signature that the information on financial statements are accurate. Another thing the law said is companies have to hire an outside auditor. Now, an auditor simply is an accountant who checks the work of other accountants. Right? Why? Well, because they all play by the same rules. Remember, publicly traded corporations play by the rules that we call GAAP, generally accepted accounting principles. All accountants, all CPAs know GAAP. So one CPA can look at the work of another CPA and understand whether they're following the rules or not. Pretty simple. So that's basically what an auditor is, an accountant that checks the work of another accountant to see if they're following the rules of GAAP. But companies are required to use a company that, an accounting firm that they don't do business with, an independent auditor. So they can come in independently, they have no other relationship with the corporation, and look at their books and give a statement. Yes, they're following the rules. No, they're kind of skirting the rules. Okay. Every time Congress passes a law, the law itself doesn't, enforce itself. You actually have to create a small bureaucracy to make sure the laws are being followed. So Congress created the Public Company Accounting Oversight Board. This is the basic executive piece, the administration of the law, to make sure the law is being enforced by publicly traded corporations. So they're sort of the cops, the accounting cops in this case, for the Sarbanes-Oxley Act. Okay. So the issue of internal control, again, companies have to put in place certain procedures, they call them methods and measures, to help keep the assets safe. The most important thing you need to know about these controls is the purpose of having them is so the assets of the company stay safe. They're not taken. Okay. So safeguarding the assets are the critical piece. That's why I circled number one. Of course, internal control happens to be doing other things, positive things. One is that the accounting records of these companies are more reliable and more accurate because they have these controls in place. So they have a better handle on what's going on and can see their financial picture better. Strangely enough, usually when Congress enforces a law, businesses all get upset because it's going to spend more money. This particular law actually made operations more efficient. Businesses put in and examined their processes that they were able to make their operation a lot more efficient than it used to be. So they can thank Congress for that. And it has been helpful. However, all companies have to have, in essence, large companies, they have to have a compliance office, which means they basically have a small department with a compliance officer and people that work there that make sure they're following the rules, the accounting rules that are required to be met. Okay. So we're going to be looking at some components of internal control before we look at the actual techniques that you might have experienced in the workplace. So the components basically revolve around the environment that already exists in a corporation and how much control or lack of control is there. Looking at the risks for fraud are important as well. What activities, control activities they already have, and on how they're working. How is this being communicated to others, and is that information working out? And if it's working out or not, they have to monitor it and correct it. So there are some components to this that companies have to look at. But here are the basic principal activities that you might have seen when you were working for a particular business. The most common one is to establish direct responsibility for an activity. One person is responsible for a given task. That's very, very common when you have, say, cashiers that have their own drawer. Okay, so in this way, the company is establishing responsibility to a one person of everything that's happening with their cash drawer at their cash register. They're responsible for it. So another person comes in, they have their own cash drawer. And so that's an establishment of responsibility. You can task one person with being responsible for this task. And thus, if anything goes wrong, you know who to talk to. You know who to talk to. Right. You can also establish that by limiting access to certain people. So in addition to maybe the cashier having access to the drawer, that cashier's manager might also have access to it. Another thing that they do is separate duties, segregate the duties so one person doesn't control too much, right? And so this means that different people are responsible for very related activities. So there's sort of a check in place, right? So for example, here you have this accounting employee who is actually keeping the records of all the cash transactions that are happening in the company. They're keeping the record only. Whereas this particular employee here is actually holding on to the cash. They literally have the physical cash on hand. And so this segregation of duties means that these two folks should have the exact same story because they're dealing with the same thing. And thus, you are ensuring some accountability here, okay, from that. Again, in essence, whoever's keeping records for something needs to be, a different person has to physically have that asset. You always want to make sure that that's at least two people that are involved and that they have the same story, what's going on. Another thing that you probably have noticed too is there's a lot of documents that are in corporations. This is done on purpose because documentation allows for accountability. Okay. That's why we know, for example, and this is where I was talking about, certain assets have some more protection. Because when a company gets inventory, it's delivered to it. They're going to have a list of that inventory. It's often going to be scanned in. There's going to be purchase orders and other things to check. Same thing with supplies. When a company orders supplies, you can actually see there's paperwork. This is how many supplies. This is physically what we've got. With cash, it's hard. It's hard. We have limited amount of documentation procedures for cash. So it's really important that we have more activities to monitor that. Okay. And then you've all seen many, many different types of physical controls. And these are important to know. I think everyone has probably seen, although a lot of businesses don't use them, some type of time clock. Now, whether, years ago you used to punch in, maybe those systems still exist. A lot of people perhaps have to swipe in. They might have an identification. They swipe in or they put in a code to say, I've started my work shift now. And when their work shift is done, they put another code in or swipe to say they've ended their shift. But companies that don't have this physical control, like a time clock or a swiping device, are basically allowing employees, in some cases, to steal time. So, in other words, you can say you've worked 6 hours when you've actually worked 4. Well, there's no physical control to stop that from happening. And thus, you could steal 2 more hours of wages from your employer if you wanted to. So, time clocks are part of those physical controls that are important. Every building that you work in, has alarm systems of one sort or another. And particularly in retail, think about it, retail, everything in the store is for sale. That's how they make their living. They certainly want to make sure that no one is breaking in or no one is taking stuff. So they will have alarm systems all over the place. Also in retail and a lot of others, there will be whether inventory is tagged with special tags, so you can deter anyone from taking it, or it's monitored. Smile, you're on camera type of thing. All of these are meant to be physical controls to protect the assets of the company, in this case, the inventory that the company sells. That's really, really important. Inventory is also kept in various cabinets and in warehouses and other things like that. And all of those are often locked. And you need either a special key or some special code in order to get into those types of things. So those are also physical controls that are important. Then, of course, you might also, before you get into a building or into anything, you might have a special pass key, might be a code, might be a finger tip, might be an eyeball scan, might be something. But the purpose of that is to physically understand who was there at that time, should anything go wrong. And then, of course, a lot of businesses, particularly when you're looking at, say, bars, restaurants, and things where handle a lot of cash, they will have a safe or a vault in the back room somewhere. And it's important that not everyone has access to that, right? Because you have to safeguard various things. So these physical controls are really important, and you've probably have seen and experienced some of them or more. Bigger corporations can actually use other people in the corporation as an independent auditor or verify things independently. So, for example, remember we went back to the two employees. This one is maintaining the records of the cash. This person is actually maintaining the physical custody of the cash. There could be a third person who is monitoring all of that and verifying all these things. And anything that is different is reported to management. So that would be sort of a discrepancy between the records could be reported to management. And believe it or not, human resources are involved. The Human Resource Department is really involved in this too in a number of ways. First of all, this slide starts off with the issue of bonding employees. So let's start off with that. Bonding is, not the 50 Shades type. We're talking about insurance. Okay, bonding of employees is really about are the employees you're hiring insurable against theft? That's basically what bonding an employee is. And that's part of why they need to conduct a background check and do it well, because when you get hired at a particular company, that process of that background check indicates that there's nothing in your background to stop you from being insured. Because again, that bonding is really sort of about the idea that if you take something, the company is covered. The company has insurance against any theft you might create. That's what bonding of an employee is. And in order to get insurance or bonded, you need to have a clear record. So some people that might have sort of a CORI, a criminal offender record that includes things like embezzlement or theft or things like that, they probably can't get in. They can't get bonded. They're not going to be able to be insured. And so the company probably isn't going to be hiring them because of that. Companies are not willing to take a lot of risks in that regard. They want to make sure the people that they're hiring are able to be insured against stealing. Another thing that a company does will either require you to take a particular vacation or change your duties around. Why do they do that? Well, basically, if you're gone on vacation for a week or two, and usually they try to have you go away for a while. The reason is they want to see while you're away if anything's changed. Okay. What do they mean by that? Well, do we have more cash on hand than normal? You know, they look for discrepancies based on when you were here, when you weren't here. And because if things changed a lot, it could be because you were stealing from the company. That's another way, that's another reason why they rotate employees around. Once you rotate employees around, they are able to take over, right, the jobs held by somebody else. And thus, if anything is different, they're going to be reported. And so you can tell if someone's up to any no good, somewhat, stealing to some degree. So that's important to know. That's important to know. You're going to be hit with a lot of frauds here. So there's when you look at internal control to stop a fraud, we're really kind of looking at understanding the intersection of business and crime. In accounting, we call that forensic accounting, but and it's a very interesting field for those that are interested in learning more about it. But it is something that all businesses need to take seriously. So you're going to be, and much of your homework is going to be on these types of anatomies of frauds. Which control mechanism was missing? Which control mechanism that you learned about internal controls would have stopped this from happening? That's the homework. So here we have a person who is a training supervisor for Colossal Healthcare. And what did this person do? Trained employees on claims processing. Okay. So this person would create fictitious claims that were used by trainees. These claims were then sent to the accounts payable department for payment. Of course, after the training class was done, she would normally notify accounts payable that, oh, X, Y, and Z are fictitious. Please don't pay them. It's just part of our training. Unfortunately, this person did not inform accounts payable of everything that she was up to. And part of the problem was this person was able to create some fake companies and then have fictitious claims paid to her own fake companies. And she let accounts payable pay it. This was a colossal failure because she was able to grab $11 million over time. So I would say definitely it was a colossal failure. This company is named properly because she was able to grab $11 million over time. So what was missing? What was the control that was missing? Well, the missing control was the first one, establishment of responsibility. In this case here, the healthcare company did not restrict the responsibility for both creating and approving a claim, right? That was done by the same person, so you had no way of breaking that up, but it would have helped a lot. The training supervisors should not have been able to do these, particularly on a live system. They probably should have had a dummy system set up for training, but instead they didn't. So again, very important to establish that. Here's another fraud for Larry Fairbanks. This person was the assistant vice president, really, of communications at ASOP University. And Larry was allowed to make purchases under $2,500 for his department without approval from, say, the accounting department or whatever the process was at that university. Unfortunately, Larry liked antiques and collectibles and bought them. And, he was able to basically create vendor invoices for payment to get reimbursed for those. Boo. Larry knew, as assistant vice president, how things worked. So he could create fake invoices that looked very much like everything else, submitted it, and they were paid. How much did Larry take? Almost $500,000. That's a lot of scholarships for students here at ASOP. That's quite a lot of money. These things happen. Biggest problem, segregation of duties. He was able to order the items. He was able to receive the items, and he was able to receive the invoice. Some of these had to be broken up in order for fraud to stop being committed. Okay? He had control over the entire process, and thus that created a possibility for fraud. This person had the same issue. This particular person here was an accounts payable clerk who prepared and issued checks, but this person also reconciled the bank statement, which is important because who clears the checks? The bank, and that's on the bank statement. So this person was able to basically create different accounts, change the names on the accounts to conceal it. She was the one who also reconciled the bank statement, so no one ever saw the check being altered or the bank paying the wrong check. She also grabbed over $500,000, which would have built her, I'm sure, a pretty nice home. But again, in this case, there was no segregation of duties, right? She was the one who had physical custody and record-keeping custody of everything. So no one else knew what was going on. She was able to get away with that for a time. Okay. This particular situation here were about travel costs. Employees at this corporation called Mod Fashions, they traveled a lot. They were all designers. And they were required to submit receipts for various expenses that they had. So for example, they could include a detailed bill for the meal, or they can include a credit card receipt for the meal, or they can include a copy of the credit card bill to get paid for the meal. The problem is the designers who worked very well came up with a scheme together. Now that's what collusion is, together working out this type of a scheme. They submitted claims for the same expenses. So one would submit the receipt, the original receipt. The other would submit the detailed bill. The other would give the credit card. So thus, instead of costing the company $200 for the meal, it cost them $600 because all three of them got a $200 check. How long did this go on? Well, quite a while. $75,000 buys a lot of food by any stretch of the imagination. And so, this is a problem. What was the big problem? Documentation, right? The company should only require original detailed receipt, nothing else. Another thing they could have done, which could have stopped this totally, is give them a corporate credit card instead of having their own. So when the company has their own corporate card and gives it to employees that are going on a trip, they know everything that the employees are spending money on because it shows up on the credit card. That's another way to control it, but that would also be a documentation issue. Okay. There's a lot of other frauds here. This particular fraud was $250,000. Why? Because the physical controls were lacking in this case. So again, physical controls are important. This particular fraud was, again, unable to have an independent verification of expense reports, which is important. I will go over this last one as well. This person was a desk manager, and she was best friends with the head of housekeeping at a luxury hotel. They never took vacations. So this is like huge red flags, right? Who doesn't want a vacation? So there were reasons why they didn't take vacations. Okay. Basically what was going on is these folks were able to grab almost 100 grand. Why? Well, because they were able to exploit the lack of human resource controls. First of all, they never did a background check on the desk manager. If they had, they would have known that she was fired from a previous employer for similar stuff. Okay. And the only way they knew that there was a fraud going on is this person, Ellen, was very sick and had to take a day off. And then they kind of noticed some things were different. Okay. So if they had forced regular vacations, they would have been able to catch this thing much, much earlier. Okay. There are some limitations to internal control. Certainly, there are benefits that come with it, but putting in control procedures costs money. The cost should never exceed the benefit. So that's something businesses have to look at as well. Certainly, the size of the business is going to matter a lot too. The smaller the corporation, it could be a bit more cumbersome. It's hard to segregate and separate things when you rely on a smaller group of people. It's just much easier when you're much larger. You can separate and have a lot more controls. When it's smaller, it's much harder. And then any system you come up with is still subject to fail because it's a human element that's involved. We're fragile beings for sure, and even some folks who have the highest standards of ethics and so forth will sometimes fall down from that, make bad decisions. But that's really all it usually takes. So a lot of your homework is going to be based on, a situation that's occurring, and can you identify the control activity which would have stopped that from happening? Okay. And so that's really what the homework is really kind of about here. Learning objective 2 is the exact same internal controls principles, but specific to cash. Again, cash is it's the most vulnerable asset because, like I said, if you found a $20 bill on the floor and you picked it up, you probably wouldn't wave it in the air and say, "Hey, did anyone drop a 20?" Because you got like 10 people say, "Yeah, that was my 20." It's harder to know and harder to track. So it's really important that whether cash is coming in or going out of a company, which is what this is talking about, they are tracking it as well as possible. Okay. I did want to point out to you some information about how employees actually steal from companies. The most common is this first one here. Asset misappropriation is a nice way of saying they took stuff. So that means that the theft could be of cash. It could be taking of inventory, taking supplies, other types of things. This is unfortunately the most common type of fraud that's going on. But thankfully, it costs the least to the employer. It still costs money, but it costs the least. The biggest problem is the last one here, that financial statement fraud brings down the company in many instances. Okay, so it's less frequent than the others, but it is by far the most costly thing that's going on in terms of fraud. In the middle is good old-fashioned corruption, bribery, extortion, other wonderful things that happen. Not, but that certainly does take some time. If you look at the median loss here, the number that's the median, that's the middle number. So the median, remember, is if you had a group of numbers and you listed them from small to large, the one that's smack dab in the middle of that list is the median. So for your asset misappropriation, again, that's most of the fraud that's going on. But the middle number is $130,000. That's still a lot of dough. It's not a lot of things to take. But as you see, financial statement fraud, the least of all of them, the least common, but certainly the most costly. Okay. So that is Chapter 7 in a nutshell, in essence. Very important to understand how these are affecting companies and what they actually have to do to fight it. Do you have any personal examples of any of this stuff going on?